So Jim, just mentioned earlier, S&P down 6+% for the year, but up 6% off those lows just 4 days ago. Stocks are a lot cheaper if you believe the earnings. Where does that leave you as an investor?
You know, you showed some really good charts up there a little while ago, and I like all of those charts. We had a 10% down quarter that's really unusual. But investors can be talked off the ledge a little bit here. And technically, we've gone through a lot of damage. We have not solved anything technically yet. All major indices are below their 200-day moving averages. But whenever we've had quarters like this, we've had 19 of them since World War II. The next quarter, 2 quarters, and year were all very robust in the market. I don't want to go through all the numbers, but they were all very good. Secondly, tax selling. This year we had a lot more of it than we usually have because a lot of investors took those big cap tech names. They didn't sell them last year because they were still working. Finally this year they weren't working. They took multi-year profits on these things. They had to offset some of those with losses, and so you had exacerbated tax selling. Finally, we're going to have pensions that start to come back in and rebalancing into the market. Remember, 10-year Treasury, 2.7 and change, that's not going to attract a lot of investment money. Eventually, there's going to be some money that comes back into the market here.
So you're sounding fairly optimistic, despite some of the uncertainty that we've encountered here in this month of December. Jim, what part of the market are you telling clients to buy? The most beaten down or the ones that have held up relatively well, like healthcare?
You know, that's a great question. I think you can barbell this. I think you can buy some of these names that didn't sell off, because that shows you if they didn't sell off when the market's just getting trashed here, that institutions and mutual funds and hedge funds, they don't want to sell these guys. So I like healthcare. They held up pretty well. Now, do you go back to the beaten down tech names? They're still, if you look at the charts, they're still very, very volatile. We also like value, though, on the other end of the spectrum, and value has really underperformed. It's at multi-decade lows. But the challenge on value is 25% of that index is banks and 12% is energy. And we've seen what these areas are doing. They're not bouncing yet. I think you have to be patient there while still looking for an opportunity to buy. Wait for the charts to shape up a little bit.
All right, be patient, but close your eyes and hope that mean reversion takes place?
Yeah, I think we're going to see some mean reversion. Look, none of this is justified economically. The economy's doing pretty good. If you look at what senior loan officer surveys are saying.
People say that in 2007 as well.
Yes, they did, but we saw a lot of credit freezing up in 2007 prior to the break in the market. We saw all sorts of underlying fundamentals really start to deteriorate before the market broke. This time, economically, we're really pretty sound. The banking system is really pretty sound, and oil prices are trending lower. Most recessions are preceded by oil prices trending higher. That's not happening now. So I think we're going to be okay. And now listen, we've still gone through a lot of damage here. It's going to take a while to work this out. But by and large, at the valuations we're at now, which over the last 30 years are a pretty reasonable spot, I think we have some room for upside. And I think the headwinds, the Trump trade wars, the Federal Reserve Board, some of these things are going, and the budget are going to ameliorate probably in the first 3-4 months of this year.